Let me introduce our first presenter today. Our first presenter is Dan Passarelli. He is from Market Taker Mentoring. Now, Dan Passarelli is an author. He is a trader and a former member of the Chicago Board Options Exchange and CME Group. Dan has written 2 books on options trading, Trading Option Greeks and The Market Taker's Edge. He is also the founder and CEO of Market Taker Mentoring and a leading options education firm that provides online options education, options newsletters, and personalized one-on-one coaching for option traders. His company website is http://www.markettaker.com. I will be sending you the link to that in just a moment here. Now, Dan began his trading career on the floor of the CBOE, and he as an equity options market manager. He also traded agricultural options and futures on the floor of the Chicago Board of Trade, now part of the CME Group. In 2005, Dan joined CBOE's Options Institute and began teaching both basic and advanced trading concepts to retail traders, brokers, institutional traders, financial planners, and advisors, money managers, and market makers. And in addition to his work with the CBOE, he has taught options strategies at the Options Industry Council, the International Securities Exchange, CME Group, the Philadelphia Stock Exchange, and many leading options-based brokerage firms. Now, Dan also contributes to financial media such as TheStreet.com, Fox Business News, Bloomberg Television, BNN, National Public Radio, and CBOE blog. And he has a weekly featured video on CBOE TV. Now, without any delay, I'm going to go ahead introduce you to Dan Passarelli. I'm going to go ahead and make him the presenter right now, and he can begin his presentation. Dan, are you ready to begin?
I sure am. Thank you for that kind introduction.
Great. You can go ahead and take over now, Dan.
All righty. Well, hello, everyone. How is everyone today? Hope everything is going well. Just making sure you guys can see my screen. Let's see here. Can you guys see my screen?
Yep, we can see it now. Thank you, Dan.
Awesome. Okay, great. So welcome, everybody. Really glad to be here and be talking about such a really important and timely topic. We are talking about the low VIX, which is the environment that we're currently in, and exactly what that means to your trading. Now, before we get started, I would like to point out that option trading is not necessarily for everyone, and you should certainly read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS or emailing me. Okay, so I'd kind of like to take a look here. It looks like I can see people's questions, so that's great. And I want to see who currently uses volatility in their trading. So what I'd like you guys all to do is go down to where it says questions, and if you typically do some sort of volatility analysis in your trading, type the word yes or the letter Y, and if you don't, just give me a no or an N. I ask this question a lot, so I'm going to see what the results are going to be. And preliminary results are exactly what I would have expected. It's about half and half. About half of you guys do volatility analysis, about half you don't. That's very typical in the presentations that I've been doing lately. Except for my students, because all my students use volatility analysis because it's very important to your trading. I'm going to show you exactly what volatility is and how you can use it to gain an edge in the options market. So here's the deal. There's basically 2 faces of volatility, if you will. There's realized volatility, also called historical volatility, and implied volatility. And by the way, guys, this is the part of the presentation where I'm giving you the background, I'm giving you the knowledge you need to understand volatility, the VIX, and everything else we're going to talk about. And then I'm going to give you some trade ideas. So this is sort of like a 2-part presentation. One is like education, stuff that you can take away and use for the rest of your life to help you trade better. And then it's here's some ideas on how to trade this environment. All right. So realized volatility, that's kind of the easy one. Like that's the realized volatility is basically what you think of when you hear the word volatility. It's when you take a look at a stock chart, if you see that the stock has moved around violently, then it has had a lot of realized volatility. It has a high realized volatility. If you see that the stock has barely moved around at all, it's like flatline, the most boring stock in the entire world, then that means that it has a very low realized volatility. All right, so that one's kind of the easy one. Like that one makes sense. When I said the word volatility, that's probably what just intuitively came to mind. Now, it's measured in annualized standard deviation. What that means, don't get too hung up on. Just get used to using the units. Just get used to looking at the volatility number. If you want a great mathematical definition of what standard deviation is, Google it, baby. There's a great Wikipedia article that'll make your head explode. That's my best advice. Implied volatility is different. Implied volatility is sort of the tricky one here. What that is what it is it's basically how cheap or expensive options are. Now you may look at that and say, well, geez Louise, what does volatility have to do with how cheap or expensive options are? Actually, it has a lot to do with it. Think of the economic purpose of options. Options are used for what? To hedge. So when traders fear that the market will get more volatile or that a particular stock will get more volatile, they buy options to hedge it. They buy puts if they own the stock to protect themselves. If they want to get long, they buy calls instead of buying the stock because they have less risk. It creates demand when the market fears volatility coming. So you know what happens? You had economics in high school, right? Supply and demand curves, remember that business? Well, the price of options goes up when people fear volatility coming. So these two concepts of volatility are very, very different, but very, very related. One is sort of backwards looking. It's the volatility that has actually happened in a stock. One is kind of thought to be forward looking. It's the volatility that's expected by the market. Now there's a little bit of a caveat with that, and this is an incredibly important caveat, and it's something that a lot of traders don't really understand and consequently are not able to use this concept. Here's the deal. Option prices rise and fall, I mean, for a number of reasons, right? Like calls get more expensive when the stock goes up and less expensive when the stock goes down. But forget all that. Hold all that constant. If the stock doesn't move and Goldman Sachs comes in and buys 10,000 options, guess what? The price of those options, calls, puts, or whatever, is going up. It's supply and demand. So a firm like Goldman Sachs probably has prop traders who are just trading delta neutral strategies and therefore trading the volatility or the vega, as they say. But there's a lot of traders out there who aren't Goldman Sachs, a whole lot, millions of retail traders just like you guys. And some of them are really smart, and I'll bet there's a lot of you guys watching this presentation who have a strong background in trading and you really know your stuff. But I'll bet there's a lot of you guys who are pretty new and you're just learning. And sometimes when people are new and just learning, they subscribe to some newsletter or something like that. And they just kind of do what the person in the newsletter tells them to do, which I highly recommend not doing, of course. You never want to just trade blindly following somebody's recommendations. But I come across a lot of traders who do that, unfortunately. And if there's a guy who's selling a newsletter who has a distribution list of 1,000 people, Well, there might be 1,000 people buying a 5 lot in these calls that he's recommending. That can drive the price higher, and these people are not looking at volatility analysis. They're just, buying calls because they think the stock's going up, or worse yet, for no good reason, just because some guy told them to. That creates noise in the volatility market. That means volatility, the price of options can get cheaper or more expensive for no good reason. It's what an economist would call an inefficient pricing model. That is good for traders. That creates an opportunity for you. That enables you to sometimes buy underpriced options and sometimes sell overpriced options. Now, this part of the presentation I'm spending a good deal of time with because it's super important, and there's a whole lot of, especially novice traders who don't understand this about the options market. And I talk to people all the time who are interested in my coaching program, and they say, hey, look, I've been trading for 3 years, and sometimes I make money, but then I just lose it all back, and I can't figure out what I'm doing wrong. And 9 times out of 10, this is what they're doing wrong. They're not getting, this is what I call getting edge on trades. They're not buying options only when they're cheap and selling options only when they're expensive. Now, there's an index called the VIX, and I bet most of you have heard of the VIX. Some of you probably look at it very frequently. Some of you probably never looked at it. The VIX is really important, and it's something that from this day forward I want everybody to be looking at. When you log into your computer and you open your trading platform, you get ready to trade, probably one of the first things you do is you look at where the S&P 500 or the Dow Jones is trading, right? You want to see what the broad market is doing, and then move on to the equities that you might trade. Maybe then you look at an Apple trade or Ford trade or something. But it's very, very common for people to look at just a sense of, hey, what is the stock market doing? So you look at these indexes. But if you're an option trader, you also need to know, well, right now, what are option prices doing? Are option prices overall cheap, or are option prices right now overall expensive? That, ladies and gentlemen, is what the VIX tells you. It's the CBOE Volatility Index, and it's got a few different interpretations, and we're going to go through those right now. What it is, by definition, is it's the implied volatility of the SPX, which is the index on the S&P 500, of a synthetically created 30-day option. Now, I say synthetically created because there's not always 30 days until expiration. Like today, there's not 30 days until anything expires. There's weeklies that expire in a couple days, serial weeklies that expire, in 10 days or what have you, quarterlies, monthlies, but nothing expires in exactly 30 days. So what they do is they take a weighted thing, and they say, well, what's the option that expires in just less than 30 days? What's the option that expires in just more than 30 days? And we'll just come up with a weighted average. And they also weight in the money, at the money, and out of the money calls and puts. So, there's a little bit of what I would call voodoo to it, if you will, because they're doing a lot of weighting and a lot of tinkering to sort of normalize this. But it's a reasonably accurate account of volatility. Now, the Dow Jones Company, who started Barron's and Wall Street Journal, they refer to the VIX as the fear gauge. And that implies that, well, when the VIX rises, the market, it's doing it because the market is scared, and investors are buying puts, and that forces the price of options up. There's something to that, but to my point before, there's a lot of noise in the options market because a lot of novice traders don't trade based on volatility assumptions. So you can take advantage of that if you know how. Then some people use the VIX as a directional indicator. Now, I do not. There's an observation that when the market goes up, volatility goes down. When the market goes down, implied volatility goes up. This is true for the VIX and the SPX about 80% of the time. 20% of the time, they move in the same direction. So not a super reliable indicator, I mean, if you're using VIX futures or options or something as a hedge, You know, that's like saying, well, hey, your insurance policy only pays off 80% of the time. How'd you like car insurance that only pays off 80% of the time? 1 out of 5 accidents, oh, sorry, luck of the draw, we're not covering you this time. So it's not very reliable, and also it implies that it's a leading indicator, which it's not. When the market goes down is when people typically buy puts. I mean, it doesn't make sense. You would want to think that people buy puts before the market goes down, but people can't see the future, and people have knee-jerk reactions. So typically what actually happens is the market goes down and then volatility goes up. So it's a lagging indicator. The VIX is also referred to as the market's estimate for future volatility. So this, of course, is predicated on the concept that the market sort of collectively gets together, and when they expect volatility to rise, they buy options. So there's a couple problems with that. One is just empirically, I've seen that does indeed happen sometimes, but not always. I mean, there's not like a council of elders of the market and everybody gets together and votes if option prices should go higher. Your trade is your vote. If you buy calls and somebody else, you know, sells calls, you know, the price doesn't go up. It's only when people are going into the market and buying a bunch of options and the buyers outweigh the sellers. But like I said, there's a lot of noise in the market, and I'm going to show you now how to take advantage of that. First, let's look at the current VIX picture and the future outlook. Right now, the VIX, so again, you know, the VIX, the way to think about the VIX is that it is what the market considers, what the VIX is the implied volatility of the S&P 500. Our option price is now low or high. Well, option prices right now are very, very cheap. Very, very cheap. The VIX at this moment in time is 1181. Now, you look at a 20-year chart of the VIX, and we're hovering down near the bottom of that 20-year range. The VIX is kind of a weird thing to trade. Like, you can't use moving averages and typical indicators that you would use with a stock or index or ETF because the VIX doesn't work that way. There's a lower bounds. It can only go to 0, and you know, I've never seen a stock that had a volatility less than 8 probably. It can only go down so far, and it can only go up so far, and when it does go up a lot, it tends to only be there for a day or two. So it trades much, much differently than a stock. So right now, because the VIX is hovering at its low, there's a couple important implications. I mean, one is the market is complacent. You don't need to know anything about the VIX to know that the market is complacent. I mean, if you read the, you know, investing or trading news, every day you get an article that says volumes are low, volatility is low, nobody's trading, nobody's making money. And overall, that's true. Investors and novice option traders are not making money. The guys who are making money are the people who know how to generate income by using volatility. I just read an article today that said the volume for equity trading, you know, like trading stocks, is 50% what it was 5 years ago. So yes, there's a whole bunch of complacency in the market. That means options are really, really cheap right now. However, that's a general statement. And there are many cases where options are actually overpriced right now. And in this low volatility environment, if you can put on income generating strategies for trading and selling high priced options in this low volatility environment, you can make a lot of money. You can do real, real well. So here is, that's sort of everything that I have to say about the VIX volatility, how it works. Now, what I want to do is I want to give you a few trade ideas here, okay? So let's see here. I was just looking at a couple trades before getting on here. Well, First Solar was an interesting one. First Solar. There we go. A little chart of First Solar. And as you can see, what do we have here? So the implied volatility, okay, so look, let's first look at the volatility chart. The red line is the implied volatility. The blue line is the historical volatility. Now, earlier in this presentation when I asked about doing volatility analysis, this is a volatility analysis. This is how this works. So the 30-day implied volatility is actually reasonably high. You know, it's about right in the middle of the 6-month range. And it's above historical volatility. So that means these options are actually expensive in this low volatility environment. So what we'd want to do is look for a way to make money on that by selling options. But you can't, with options, you can't sell them naked. They have to be part of a spread. I mean, you can sell them naked, but you open yourself up to insanely huge risk, potentially. So what I do and what my students do is sell them as part of a spread, so you can set up a trade where you can make just as much money as selling them naked, but you're protected if something crazy happens, which happens time to time. So if you take a look at this, the stock has support here at about this 61, about 61.5. Has some more support down here at, well, at the 200-day moving average at 60, or 59.5 rather, and then some more support, of course, down below. So this is actually a perfect setup for a credit spread. Here's the credit spread that I like. I like selling, the August 1st expiration, 61.5 puts, and at the same time buying the, the 59.5 puts. I need to get those on the screen here. So selling the August 1st 61.5 puts at 89 cents or better, and buying the 59 puts at 54 cents or better. A couple reasons why I'm picking these strikes, a couple reasons why I'm picking this sort of trade, a couple reasons why I'm picking this expiration month. So let's start with the easy one. This sort of trade I'm picking because when there's support at solid intervals and when implied volatility is overpriced, that's the criteria that traders look for to set up a credit spread. Now, why the August 1st expiration? That's easy because earnings is on August 5th. And when earnings comes out, that's when the stock can really move pretty violently. So I don't want to have on a credit spread trade like this when earnings is coming out. So I put on a trade that expires before earnings comes out, so I'm out of the trade by earnings. I'm using these strikes because I had support at around that 61.5 level, so I want to sell a strike at or below that support level. So this is a very high probability trade. If I put this trade on, the stock can fall about $1.75, which is a pretty good sized move for this stock. And I still have a winning trade. If the stock doesn't move at all over the next, what is that, week and a half, I make money. Stock goes up over the next week and a half, I make money. Now, I realize that for those of you who are brand new to options, like there's a guy here, Charles, who says, man, you're way above my head. I appreciate that. I understand that. I mean, I've been you know, I was a professional trader. I trade pretty sophisticated strategies, but I work with a lot of new traders like yourself, and I know that some of this stuff, you know, is pretty involved until you get a couple lessons under your belt. So for those of you who are pretty new to this, and this seems like crazy advanced, and you know, you feel like it's way over your head, it's okay. Just keep listening. You're going to pick up a couple tidbits, and it starts to click after a while. You know, this is, I think a lot of option traders, when they first start out, Charles, here's what happens. You say, oh yeah, well, you know, somebody told me that options are a leverage substitute. Instead of buying the stock, I should buy calls, like in the money calls. It's a good starter strategy, but in the long run, it doesn't really work. It doesn't work because you always have time working against you, because options have a theta and they decay as time passes, so you always have that working against you. You typically, with that rudimentary strategy, you don't do a volatility analysis, so you probably have volatility working against you, or at best, it's a wild card risk. And you know, the in-the-money call strategy, it's only designed to be an incredibly, you know, rudimentary first strategy that you learn, and then when you realize that in the long run you can't make money doing that, then you learn new strategies. So stick with it. And I also appreciate that I went, you know, I only have 45 minutes to talk here, guys, and I had to go pretty fast through volatility. I expect that people who this is their first exposure to learning about volatility, I'd be amazed if anybody could grasp it in the 10 minutes I spent on describing it, or 5 minutes. It's something that requires a little bit further study, but it's something that pays off in the end. That volatility analysis is this, and learning how to set up income trades like this is the key to your success as a trader. So this is your introduction to it, new guys. Intermediate and advanced traders, hopefully I'm showing you some good setup techniques that can improve what you're already doing. You know, we should also talk about the broad market, right? Because this conversation was largely centered around the VIX. So let's look at the S&P 500, because that's what the VIX measures. Let's take a look at a chart. Geez Louise. We are at the highs, aren't we, guys? For the last 2 years, this market has gone pretty much straight up. Why did that happen? Well, because the Fed's propping the market up, right? I read another article today. I read news headlines for a podcast, very popular podcast, so I read the options news every day. And there was a really interesting article. I forget what publication it was. It was a really interesting article that said, you know, trading is not about trying to figure out what should happen. It's trying to figure out why the trend is happening and then decide if you're going to trade on that. So there's plenty of times when the market is irrational and doing maybe not what it should be doing. It doesn't really matter. It's not like you can go tell the teacher on the market and the market will change to be doing what it should be doing. The market does what it does. So it's for us to decide, well, why is it doing that and how do I make money off that? So, I mean, it's no secret. The Fed has been just buying the crap out of securities to prop up the market. And they've been doing that for a long time, and you know, they say they're going to taper possibly, you know, the end of this year, third quarter of this year, as soon as that, maybe. But tapering doesn't mean they stop doing it. It means they just don't do it as much. So this market is not terribly likely to decline anytime soon. Should it decline? Well, probably. I mean, it's synthetically overinflated by systematic government moves, or Fed moves. So the question is, well, how do I play this? Well, I probably want to play some sort of, if not bullish trend, a trend that makes money if the market doesn't fall. Okay? Because if tapering happens and the government just pulls back on some of their buying, the market probably won't fall drastically. It's just going to stop rising. So I want to make money on a strategy that makes money if the market doesn't fall. So it can stay where it is, it can go up, and that's a put spread. Now we've got the same opportunity here to put on a similar type of trade. The implied volatility is, I mean, it is towards the bottom of the 6-month range, which I'm not crazy about, but it's above historical volatility and has been above historical volatility for about 3 months. If you've been trading income trades over the last 3 months on the S&P 500, you've been killing it, especially if it's put spreads, which have a bullish bias. So put spreads are the way to go here in the broad market. I like to look at spreads that are short term because, you know, if market conditions change, I would need to be nimble enough to change with them. I'd be looking at something like maybe selling these August 1st 197.5 puts at 62 cents and buying maybe the 196 puts at 37 cents, something like that. This is the nature of selling a put spread. You sell a put that's below where the market is, and that's your trade. That's what you make money on because you want that put to go to zero. You know, you sell high and you buy low, or you let it expire. Typically, I don't let my trades expire, but just conceptually, that's what you could do. And then you buy another put for protection, which will decay too, and then that put that you own is losing money, but that's okay because you sell the more expensive put. You buy the cheaper put. They both go to zero. You make money. Okay, here. I'm going to give you, well, you know what? I'm going to give you another stock in a second here. But first, I'm going to talk about how to get trade ideas. How would you like all the trade ideas you need? You know, you new guys who are listening to me talk about income trades, and, you know, you're saying, hey, you know, these are income trades. I don't really know how to do them. It's kind of over my head. How would you like somebody to explain to you every single day 15 different trade ideas where you can ask questions and figure it out? How would you like to get these trade ideas from an ex-Goldman Sachs guy who's been in options over 25 years? Well, ask and you shall receive. The Market Taker Live Advantage group coaching class gives you 15 trade ideas or more every single day. Now, these classes are every day during market hours. It's 9 a.m. Central Time. That's a half hour after the market opens. You guys on the East Coast, it's 10 a.m. your time. Goes for an hour. These classes are recorded. So, you know, some people work, you know, we've got a lot of students in this class. Some of the people who sign up for this class, they work during that time, and so what they do is they sign up for the class and just watch the recordings. You know, we're not day traders. We don't put on trades that are good for the next 5 minutes. Our typical trade horizon is a couple of days to maybe 3 weeks or so. So it's okay to watch the recordings. And some people watch the live classes and they review the recordings because, you know, maybe the instructor will be like, oh, well, I missed something here, you know. Or the instructor will say, well, here's the reason why this trade works. And you think back, you think, man, I didn't really understand that. I want to see the recording. So the recordings are great. Now, wait, I don't want you to see that yet. This is probably our most popular subscription class. Normally, it's $997 for a 3-month subscription. Now, you know, those of you guys who are new to trading and, you know, don't really think about it like a business, like, you know, oh, I have to spend $1,000. It seems like a lot of money, and fair enough. You're not going to pay that ever, because anybody who's watching this presentation, you're going to get an incredible deal here. Those of you guys who've traded a while and look at trading as a business, you know, you can appreciate that as a good investment. You know, hey, you know, I invest $1,000 and I get, well, basically over 3 months, 15 trade ideas every single day. You're getting 1,000 trade ideas. I mean, if you make money on a couple of those trades, it pays for the class itself, right? But when I do these webinars, sometimes I offer a discount on these classes. And sometimes it's an incredible discount. But I still have people who say, well, I want to try it for free. And I'm saying, man, you know, like you're not thinking like a trader. Just pull the trigger, you know, take a chance on this investment. But after saying that enough times, I've decided, and I've been doing this just for a little bit now, that I'm going to give every single person in this webinar 1 week free of this class to prove to you that it's a great class and to show you the value. So you're going to be in this class for free for 1 week. You're going to get all the same trade ideas that the people who are paying for it are. You might make money on these trade ideas, and if you do, you're going to be dying to sign up for this class. But I'm not going to charge you full price. I am going to give you a discount. It's going to be $225 a month. So again, 15 trade ideas every single day, $225 a month, if you like the class and stay in after the weekends. You don't have to. You can cancel anytime. You can say, hey, you know what? This class is not for me. I'm going to drop out. You know, I'm not going to pay for this. But my guess is you will, because if you can make money on one of the trades per week, well, that's easily going to cover $225 for the whole month worth of trades. And then every other trade that you make money on, that's yours. So 1, 2, 3, go. Go to markettaker.com/GC1W. Stands for Group Coaching 1 Week. Group Coaching 1 week. So markettaker.com GC1W. Now, Alan says, how do you find the stocks to do options? That's what you're going to learn in this class. We're going to show you, you know, you're going to watch an ex-Goldman Sachs guy who's been in options for 25 years saying, hey, here's this option trade. Take a look at this. Here's why I'm picking this stock. Here's why I'm choosing this particular option spread. Here's why I'm choosing this strike price in this month. You know, some people just sign up for this class to get the trade ideas and you know, make money on trades. Noble rationale for taking a class like this. But some people sign up for this class just so that they're kind of in the head of, you know, a 25-year veteran of the options industry and learning how he does it so that after a few months, they can do it themselves. He teaches you the mindset that you need to find trades and set them up. So this is, for years, I never gave this class away for free because, frankly, I didn't have to. And frankly, I think, you know, my philosophy before then was, well, anybody who, you know, isn't, you know, I used to sometimes do this for, well, if it's $225 a month, hey, somebody who's not willing to invest $225 in their future probably isn't an actual trader and shouldn't be taking the class anyway. That was my philosophy at the time. But, you know, hey, I'm a consumer too. And I appreciate, you know, if I'm buying a car, I like to take it for a test drive, you know. I don't like to just say, hey, you know, I'm sure this is a great car, I'm going to buy it. So I'm kind of compromising. And I'm putting my money where my mouth is. You try this class, you're going to love it. You're going to love the trade ideas you get out of it. We've had some great successes. We get unsolicited thank yous that we post as testimonials on our website. I have never asked for a testimonial for this class, and I've got like 50 of them on my website. All people who are really, really happy with it. The class, so somebody's asking, who is this? Larry is saying, what time of day is the class? 9 a.m. Central Time, that's 10 a.m. Eastern Time. It's a half hour before the market opens. Charles says, can you trade with this in IRA account? Some of the trades you can. Some of it is, it depends on who your broker is. Like if you have like a not very option-friendly broker, like, you know, somebody who's not really an options broker, they set up crazy rules for your IRAs where you're barely allowed to trade options. But if you have an option-friendly broker, you know, somebody like LiveOwl, Trade Monster, Thinkorswim, like a real options broker, most of these trades, I think you'll be able to trade in your IRA. Yeah, absolutely. Alan says the market opens at 9:30 a.m. Yes, Eastern time. It opens at 9:30 a.m. So you're obviously on the East Coast, so the class will start at 10 a.m. for you. All right, so I'm getting the couple-minute warning here, guys. Do we have any other questions about this class? This is, I mean, obviously, I'm sure most of you are going to take me up on this because, well, because it's free, and you can only benefit from this, and that's sort of how traders tend to think, right? You know, value. Larry, yes, these classes are recorded. These classes are recorded, and you'll have access to the recordings for a full month. There's this person, I don't know how to pronounce your name, I think you made it up, CEW, says, could you please recommend a decent book to explain why markets move? Why markets move? I can't think of one offhand. I've written a couple of books on options, The Market Taker's Edge and Trading Option Greeks. They don't really explain how or why markets move, but they're great for option traders. Another question, does it apply to the UK? Do they allow dealing with options in the UK? What's a little more popular in the UK is something called spread betting, which is not legal here. It's kind of a weird thing. This class is all in the context of US options, so if you live in the UK, certainly you can trade US options. Yes. One more question. The web address is markettaker.com/GC1W. Everybody go to that page right now. markettaker.com/GC1W. Everybody get there? Sign up now for this free trial. You can do that as long as this webinar is going on. Larry says, is the daily class recorded in case you can't see it at the time it is on? Yes, it is. It is recorded. And honestly, about 50% of the people sign up for this class and only watch the recordings. They don't watch it live. I think it's, it's very beneficial if you can watch it live because you can ask questions. You can say, hey, I want to take a look at, Tesla stock. Is there a good trade there? It's very interactive. It's a webinar like this. We actually use GoToMeeting, which is what you're watching this webinar on. And basically what I was doing here with LiveVol, what I was doing here with LiveVol, like sitting here finding trades for you, you just got a couple of good trade ideas here today. If you take one of these trade ideas and if you make money on it, I mean the second one was kind of hypothetical. I was just kind of doing somewhat random strikes. The first one, the FSLR one, that's pretty well thought through trade. You take a trade idea like this, you make money on it. Would you be willing to pay for it? Well, yeah, if you know anything about business or trading, obviously, I'd be willing to pay a little bit of money to make a lot of bit of money, right? So that's the whole concept of this class. It's a great way to get trade ideas, and even more importantly, it's a great way to learn trade setups so that you can do it yourself. I got the 2-minute warning here, so that was about a minute ago. So I guess, unfortunately, we're kind of out of time here. One more time, that web address is markettaker.com/GC1W, and obviously it's kind of a no-brainer. Sign up for that today and try this for a week. You will not be sorry. This has been a presentation of Market Taker Mentoring. I'm Dan Passarelli. Follow me on Twitter, twitter.com/Dan_Passarelli.